So today's webinar is titled Year-End Tax Planning and What to Expect for 2022. My name is Sam Macy. I'm an associate wealth advisor here at Boucher Financial Group, and I will be the moderator for today's webinar. And we're so happy that you could join us. Our presenters today are Nicole Goebel, Jennifer Foley, and Vincenzo Testa. They are all CPAs and on the wealth advisor team at our firm. Combined, they have over 40 years of tax, financial planning, and advisory experience. If Steve Boucher was here, I know that he would be talking about how our team is one of the most dynamic teams that he's been a part of, and he has consistently been investing and bringing on professionals to expand our expertise and our services that our firm offers. So I know that our team has put together a really great presentation for you today. There's a lot of insightful and useful information that we hope that you take away from it. And I know that today's webinar is going to be covering three main topics. So the first topic that we will be discussing today is gifting strategies, then maximizing retirement contributions, and lastly, potential tax changes in the Build Back Better Act. So without further ado, I'm going to hand it off to Jenny Foley, who will be discussing gifting strategies.
Thank you, Sam. Good afternoon and welcome, everyone. Thank you all for taking some time this afternoon to spend with us. The end of the year is a popular time to donate to charities that are important to us. And there are several ways to do this tax efficiently. With another successful year on Wall Street, a lot of our portfolios have shown great appreciation, and something to consider is donating gifts of appreciated stock. One strategy would be to do this, and you would bypass paying capital gains on the sale, as well as recognizing the full fair market value of your donation. This is something that when you do this in kind, it can help diversify if you have an equity position that you have been looking to trim back, and it can also help rebalance your portfolio. A second thought as far as a donor advised fund. So in 2018, the tax law changed where the standard deduction was doubled, and most of us were able to utilize the standard deduction as opposed to itemizing. One thing to consider is to bunch your charitable donations into 1 year. So doing, say, 4 or 5 years worth of donations at the end of this year would allow you to go above the standard deduction and realize the full charitable deduction if you were to itemize. And a way to do that is setting up a donor advised fund. So this is a gifting account that's set up with a public charity, and it would allow you to make a large contribution in 1 year and then take time to give those grants out over the course of the next several years. So it would basically be front loading a charitable deduction now and would allow you time to spread that donation out over the next several years. Another really great tool is a qualified charitable distribution. So for those of you that are in your required minimum distribution years and you would like to keep your income lower, if you take a piece of your required minimum distribution and designate it to a charity, you can do this up to $100,000. It would be, you would not have to pay ordinary income tax on that amount that's distributed, and it would go straight to a charity. So this helps, one, to keep your overall tax brackets lower. It also helps keep your income down for those of you that are paying Medicare and are concerned about IRMA. This would help kind of keep that surcharge down as well. So it's a really tax efficient way. If you're typically giving out of your checking account now and you're in your required minimum distribution years, I would suggest you think about doing it that way. Okay. And for everyone who has been utilizing the standard deduction, something that was passed in the CARES Act, which has continued on to this year, is that you can, in addition to the standard deduction, You can deduct cash donations, $300 per person or $600 per married couple in 2021. One thing I would say, the IRS always makes note of substantiation requirements. So anytime that you make a contribution, you should keep the letter that is either emailed or mailed to your home as proof that you donated to the charity, potentially a canceled check as well. If you are concerned about whether or not the organization you would like to gift to is qualified, there are a lot of good causes out there, but you can check the IRS website. It is irs.gov/charities. And there will be a search tool in there for you to be able to go in and take a look and see if your organization is actually a qualified 501c3 organization for gifting purposes. Okay. As far as non-charitable gifting goes, I think many of you are familiar with there are annual exclusions that you can gift to anyone. It does not have to be a family member, it could be a friend. You can gift up to $15,000, 2021, $30,000 per couple to any individual without having to file a gift tax return. That's what they call the annual exclusion. If you gift more than this to anyone, that does not mean it will be subject to tax. It just means there's a process that has to be starting to track for gift and estate tax purposes, kind of eating into your annual lifetime exclusion. So this would be accomplished by filing a form 709 with the IRS, and it would just state how much you gifted and to whom. As something to note, we just spoke about gifting appreciated stock to charities. If you're gifting to individuals, we would suggest to not do this simply because they would inherit your cost basis and they could potentially be in a higher tax bracket where it would not be as an effective tool. So for individual purposes, it would probably be better accomplished to pass through an estate where there would be a step up in basis at your passing. Okay. And then another popular vehicle for gifting is for education. So parents and grandparents out there, if you would like to contribute to a 529 college savings plan, this is accomplished by, again, you can gift $15,000, $30,000 per couple. We can also front load those contributions. You can contribute 5 years at a time, but this would also require filing a gift tax return, and it would just simply be making an election there. The rules vary state to state for deductions, but New York residents do receive tax deduction for $5,000 per individual or $10,000 per couple for contributions that go to a New York state plan. So that is my piece on gifting for the year. And now I will turn it over to Vinny to speak about retirement contributions.
Thanks, Jenny. So I wanted to talk about maximizing your retirement contributions. And to start off, I'm going to talk about employer plans and the limitations of contributions to those employer plans. So for 2021, the contribution limit is $19,500. And when I talk about employer plans, I'm talking about 401ks, 403bs, and 457bs. And the limit for those in 2022 will actually be increased to $20,500. And there's a catch up if you're over age 50. So you could contribute $6,500 more than added on to those limitations that you see above. So one thing that we tell our clients is if they have not reached that contribution limit yet, and it's getting closer to year end, is to accelerate their contributions to their payroll deductions. And you know, it's December 15th now. I mean, if you were able to, you know, get the increase in payroll deduction through and for your last payroll check, I would advise you to do so, but I know that might be difficult for some. So if you have not hit that contribution limit yet, you know, it's a good opportunity to maximize your retirement account and stay under that contribution limit. For self-employed retirement plans, you typically have until you file your tax return to fund the maximum contribution, and that could potentially be October 15th if you're on extension, or if you're not on extension, it could be April 15th, and this is of the following year that the contributions are considered. Also want to talk about total defined contribution plan limits. These limits are for your employee and employer, and that total limit for 2021 is $58,000, and this is the contributions combined of the employee and the employer. And in 2022, that increases with the IRS inflation increase of to $61,000. So the other retirement accounts I wanted to talk about are individual retirement accounts, and that's your traditional and your Roth. So the traditional, any contributions you make to this are tax deferred. So when you make a contribution, it comes off your taxable income. And then when you distribute the money out of the account, when it comes time to take RMDs, or if you hit age 59 and a half and you're able to take it out, those distributions are taxable, as opposed to the Roth, where you're contributing after tax money. And when you distribute the money out of the account, where there is no RMD and no requirement to ever distribute the money out of the account, the distributions are tax-free. So as opposed to the self-employed retirement plans, you have until April 15th to make a contribution to these accounts. The self-employed retirement plans allow until October 15th if you're extended, but for the individual retirement accounts, April 15th is a hard deadline. The contribution limits to both of these accounts are $6,000 in total. And then for age 50 and over, there's an extra $1,000 you can contribute as a catch-up, similar to the $6,500 to the employer retirement plans. And one thing to be cognizant about and pay attention to is if you're contributing to a Roth IRA and you have maybe a substantial increase in income this year or next year, there's income limits for Roth IRA contributions. And if you are contributing to a Roth IRA and you're over the income limit, you could be subject to penalties, and it's really just a headache once you get into that. So really, you should pay attention to that and make sure you're not over contributing. Another retirement plan is the health savings account, which is or otherwise known as HSA. So health savings accounts allow tax deferred contributions, and if the money is spent on medical expenses, then the distributions are tax free. And the limits for HSAs are $3,600 for an individual in 2021 and $3,650 in 2022. And for family plans, it's $7,200 in 2021, and 2022 it's $7,300. And there's also a catch up for this, but rather than age 50, this kicks in at age 55, and there's an extra $1,000 available. One last item I wanted to talk about before I hand it off to Nicole is self-employed or consulting income. So if you potentially have self-employed income or maybe do some consulting on the side, there's a couple things you could take advantage of to either minimize your tax liability or maximize your retirement contributions. So sometimes when I look at client returns, when I review them, they might be doing some consulting on the side, and they have maybe $10,000 in income, but they're not taking any expenses. And that's really important because the taxes associated with being a self-employed individual are higher than being an employed individual. And it's really beneficial to take some expenses against this income to save you some money. So one of the items that a lot of people don't know about are home office expenses. So home office, the IRS allows a home office deduction if you're working out of your home exclusively. And the two methods are the simplified method and the actual method. The simplified method basically just takes $5 per square foot of your home office, and the actual method prorates the percentage of your home office compared to your home. So for instance, if you have a 400 square foot home office and your home is 2,000 square feet, that's 20%. You would multiply that by many expenses associated with your home, and you would get that deduction on your tax return. And it's very important to track your expenses when you're writing them off, and because in the event of an audit, the IRS is going to want to see those, and if you don't have any receipts or proof, they might disallow that, and you will have to pay interest and penalties, and you don't want to do that. Another last item I want to talk about is setting up self-employed retirement accounts. We were talking earlier about simples and SEPs and self-employed retirement accounts. So if you're self-employed and you don't have one set up, it could be beneficial to do so and talk to a financial professional about doing so. So I'll let Nicole take over from here.
Thanks, Vinny. And I'm sure with Jenny pointing out the substantiation for charitable contributions and you pointing out to make sure you're tracking your expenses for any deductions, that our Chief Compliance Officer is very happy to hear that we're making sure to relay that to our clients. So I'm here to add on to the wonderful tax planning opportunities that both Jenny and Vinny have provided to talk a little bit about what's to come. So, if you've been watching the news, you know that the Build Back Better Act is on the table. So what is it? Really a $2 trillion proposal, has some really important items included. Not sure what the end bill will look like, but they're looking to expand Medicare coverage. They're looking to invest in different ways to combat climate change, right? So green energy. They're also looking to add universal pre-K and overall to provide aid to low-income families. But who's going to pay for that? Taxes, of course. So they're, of course, looking to target high earners, or what the government feels would be considered a high income earner, to really pay for some of these programs. So the bill in its current form was passed by the House November 19th, but has yet to pass the Senate or be signed by the president. So of course, we're nearing year end, we're 2 weeks away, and we're not sure if anything's going to happen. So I think everyone's bracing for, the prospect of really nothing getting passed through until next year. So what's included? So there's a couple important items that we wanted to point out. And again, we will be certainly coming back to you to let you know when the final bill is passed and what that means to you. But one important potential increase is in the SALT deduction. So this is actually something that was passed back in the 2018 tax laws that reduced the cap on what you could deduct for state and local taxes to $10,000. So while the tax brackets were lowered, the standard deduction was increased, we lost our exemptions, many people ended up paying more in taxes than they would have, because even though it was taxed at a lower rate, more income was subject to that because they lost their deductions, especially in states like New York, New Jersey, Connecticut, where we have high state taxes, high real estate taxes. It was definitely an impact. So what does this mean? If they increase that deduction back up to $80,000 from the $10,000 it is currently, many more of us will get to actually deduct the full amount we pay to the state as well as for our real estate taxes. That means many more individuals may go back to itemizing deductions. So make sure, again, you're tracking those expenses, even if you've taken the standard deduction the last few years. This is something that might revert in the coming year. Also, it means that many more individuals may be subject to alternative minimum tax, right? So I think those of us in the tax world, this is kind of a very negative term, right? Because it's a big surprise when, you're not expecting it, but part of your income is now subject to at least 26 or 28% on top of what you would have been paying in a normal tax calculation. So again, this just means that it could negate some of those deductions and again, increase the overall tax rate you're paying. Another item that's in the current bill is a change to the net investment income tax, right? NIIT. Right now, that tax, and this is an Obama era tax, was 3.8%, and it applies to investment or passive income for those with incomes above $200,000 as a single individual or $250,000 as a married individual, right? So that does affect some people. But now what they're looking to do is expand the NIIT and really apply that to trade and business income. Now, they are raising the limit that would apply to individuals to $400,000 to a single person or $500,000 for a married couple. But again, this could affect a lot of small business owners, right, that have that business income over that amount. So it's something definitely to watch for and could be, again, an additional expense, especially to small business owners. And we know that many of our small business owner clients are out there and are having a hard time, with inflation, with hiring, the right people, with keeping afloat to begin with. So this could be an additional cost we're aware of. Okay. There's also some changes to some tax strategies. So we talked earlier about maximizing your contributions to different retirement accounts. So Roth conversions has been certainly a hot topic. So they're looking to basically phase this out and eliminate it in some forms. So a Roth conversion, for those of you not familiar with the term, allows you to take part of your traditional IRA or a 401k or another employer plan that you've put pre-tax money in and you've gotten that deduction on. Pay the taxes today and move it to a Roth vehicle. So you're really accelerating the taxes with the idea that the long-term growth within that Roth IRA that Vinny mentioned can come out tax-free and not be subject to required minimum distributions later on. So really, they're looking to phase that out for high income earners. Right now, there's no limit on the amount you can convert and no limit on those who can do it. And really what that would mean is those over 400,000 income single, a $500,000 married couple, they would look to phase that out over the next 10 years. So in 2031, any individual in those brackets would not be allowed to do any Roth conversion. More importantly, this law immediately limits what we call backdoor Roths. So for many of our clients who have only employer plans, they do not have a traditional IRA, what this allows them to do, this backdoor Roth strategy, is put a non-deductible contribution into a traditional IRA, after tax money, but immediately convert it to a Roth IRA. And basically there's no tax consequence because you never received the tax deduction on that contribution to begin with. So it's a way for high income earners who are under those Roth limits that Vinny mentioned to still put money into a Roth IRA. So they're looking to eliminate that at the end of this year. So if you have by chance made a non-deductible contribution this year and we're looking to convert it, make sure you're doing that within the next 2 weeks, because again, if the bill passes in the current form, that would no longer be allowed after December 31st. Also, any other non-deductible contributions you may already have in those IRAs after this year would not be able to be converted, so would be stuck in there. It does provide basis when you eventually take out contributions later on, but again, you wouldn't have the ability to convert them. And lastly, within this same context, the mega backdoor conversions. Some employer plans allow you to contribute after-tax money. The advantage is that after-tax contributions actually can move to a Roth IRA when you eventually retire or leave that employer and roll it to an IRA. However, the after-tax growth would still be considered part of the pre-tax bucket. Some employer plans allow these in-plan conversions that can allow you to take all of the after-tax money and convert it at once. And again, the savings there is on all of those after-tax contributions, and a way, again, for a high earner to get a lot of money put into a Roth in one single transaction. So I want to thank you again for joining us today. I think we've covered a lot of tax strategies between gifting, both, to your family as well as charities, maximizing your contributions, and don't forget to reset those in January and make sure you're looking at the new limits that we mentioned. But, also I wanted to mention that we do put out a lot of content. So, make sure that you're speaking with us, that you're speaking to your accountant or CPA about some of these strategies. We are absolutely happy to discuss any with you. But also take a look at our website. We do webinars regularly. We do a quarterly update on our investments, on our portfolio, on the economy. But in addition to that, we are also posting content every week on things that we feel are important for our clients to understand. So here we have from last week, Jenny's blog on year-end tax planning that covers much of what we discussed today. And we also have What is TINA and Why is it important to me, which I'm not going to release it. I'm just going to ask you to go to our website and look at Paolo's blog here. But important if you're having a conversation about bonds, about inflation, it's a great article. And so, again, I would urge you to go to boucher.com, www.boucher.com, go to our Insights tab, and we really do have all of this content. And, with that, I'll just say, please feel free to reach us, 518-720-3333. or email me at ngobel, that's NGOBEL @boucher.com, and any of us will be more than happy to assist you with anything we can. But again, thank you for joining us today, and happy holidays.